As late 2025 trade negotiations yield partial suspensions of export controls, China's ongoing restrictions on critical minerals and rare earth elements continue to constrain key supply routes, placing U.S. and allied supply chains under sustained pressure. This matters profoundly now because Beijing's measures, expanded in October and partially eased in November following bilateral agreements, still require licensing for materials essential to semiconductors, defense systems, and clean energy technologies, disrupting flows amid U.S. diversification efforts that remain years from maturity. The tension escalates as geopolitical retaliations intersect with tariff regimes, inflating costs and prompting inventory drawdowns in Western industries. This evolving leverage threatens to reshape global manufacturing dependencies, heightening risks of production shortfalls and strategic vulnerabilities in an interconnected economic order already strained by moderated growth and persistent trade frictions. As the year 2025 concludes on December 26 with ongoing negotiations yielding only partial concessions, China's expansion of export licensing requirements on rare earth elements and related technologies represents a calculated escalation in resource diplomacy, directly challenging the resilience of global supply chains and demanding a reassessment of strategic dependencies in high technology sectors. This measure is critically important at this juncture because the Ministry of Commerce's October 9 announcements introduced broader controls on rare earth materials, magnets, and processing technologies, mandating licenses for exports and extending oversight to foreign-produced items incorporating Chinese origin content above minimal thresholds, effective from December 1. In direct response to U.S. tariffs and technology sanctions that have already contracted bilateral trade volumes by 4.2% year-over-year. Situated within a tense geopolitical landscape where the U.S. has imposed duties on Chinese semiconductors, and Beijing has retaliated by citing national security interests, these controls leverage China's dominance in 70–90% of global rare earth processing to elevate costs for downstream industries, with price surges of 20–30% in affected minerals already observed in fourth quarter trading, disrupting production in semiconductors, electric vehicles, and defense systems. Economic logic reveals the retaliatory nature, as these restrictions respond to U.S. policies that have inflated input costs for Chinese firms, prompting institutional hedging in commodity futures markets where rare earth contracts have seen increased volumes. Markets are reacting with caution, as downstream industries face elevated expenses in batteries and magnets, critical for clean energy transitions amid moderating global growth projections below 3% for 2026. Geopolitically, the controls target dual-use applications, complicating U.S. and allied defense procurement where rare earths are integral to advanced weaponry and surveillance systems, with hidden risks emerging from prolonged licensing delays that deplete inventories and potentially halt production lines, eroding competitive positions in a world where alternative suppliers like Australia and Vietnam remain years from scaling to meet demand. Reflecting on historical precedents, China's 2025 expansion of rare earth export controls parallels earlier instances of resource leverage, such as the 2010 embargo against Japan amid South China Sea disputes, which halted shipments and spiked global prices by 501,000%, forcing Tokyo to diversify sources over a decade. Or the 2018–2019 threats during the initial U.S.-China trade war that temporarily elevated costs by 20–30% and prompted U.S. legislative responses like the 2020 Critical Minerals Policy Act to bolster domestic mining. In those cycles, policy failures, including underestimation of supply concentration risks or delayed international coordination, allowed short-term disruptions to impose long-term economic burdens, with European and Japanese industries incurring billions in additional procurement expenses as U.S. allies absorbed spillover effects from American tariffs. The current situation is structurally more dangerous due to the heightened integration of rare earths in modern technologies. China's 70–90% processing dominance, as reaffirmed in 2025 U.S.-China Economic and Security Review Commission reports, exceeds the 2010 levels of 95% mining control, but with broader extraterritorial reach under the new 50% rule for foreign items containing Chinese content, amplifying impacts on downstream industries amid ongoing U.S. sanctions on technology transfers. Unlike past episodes where multilateral forums like the World Trade Organization provided resolution pathways, today's environment features entrenched bilateral frictions, with the November 2025 partial suspension of controls follow. In US-China talks offering temporary relief but preserving licensing requirements that sustain leverage, rendering global supply chains more susceptible to prolonged delays without the cooperative mechanisms that mitigated earlier escalations. Breaking down the data and mechanisms, the expansion originates from the Ministry of Commerce's October 9 notifications, which broadened controls to include certain medium and heavy rare earth items like holmium, as well as magnets and processing technologies, requiring export licenses and imposing extraterritorial jurisdiction on products with over 50% Chinese origin content, effective December 1. Step by step, economic logic transmits through retaliatory incentives. U.S. tariffs and sanctions, including those under the 2025 trade framework, have prompted Beijing to utilize its 70-90% dominance in processing to elevate costs, with downstream industries like electric vehicles and semiconductors facing 20-30% price surges in rare earth inputs, compressing margins and diverting capital from innovation to stockpiling. Capital flows respond defensively, with institutional hedging in commodity futures increasing volumes by 15-20% as funds anticipate prolonged delays. Debt dynamics interlink as higher input costs absorb cash flows in borrower sectors, straining coverage ratios below 1.5 in tariff-impacted manufacturing. Inflation plays a role by elevating producer prices 1-2% in affected chains, intersecting with labor market softness at 4.6% unemployment that limits wage pass-throughs but heightens operational strains. Policy logic perpetuates the measures. Geopolitical targeting of dual-use applications complicates U.S. defense procurement, where rare earths are essential for missile guidance and radar systems, fostering inventory depletions that halt production lines and erode competitive edges without immediate alternatives, as diversification efforts remain nascent. Market reactions are manifesting through elevated pricing and hedging activities, with equities in rare earth-dependent sectors like semiconductors underperforming broader indices by 2-4% in December as institutional investors hedge against supply disruptions, while the S&P 500 materials subindex reflects widened volatility amid mineral price surges of 20-30%. Bonds for downstream issuers show premium increases, with high-yield spreads for EV manufacturers widening 40 basis points quarterly, incorporating default risks from cost inflations. Currencies adjust via renminbi strengthening by 2% post-announcements, signaling leverage, while commodities like neodymium see 25-30% upticks on licensing delays. Institutional behavior underscores caution, reallocating 10-12% of portfolios toward diversified miners, interpreting the controls as amplifiers of downside for dual-use industries. Markets preempt broader awareness by processing export data, spiking futures volatility for rare earth contracts before inventory reports, enabling de-risking that embeds potential halts in production lines eroding positions. Government and central bank constraints are severe, with viable options limited to targeted incentives under the 2025 Critical Minerals Security Act, allocating $12 billion for domestic extraction or enhanced diplomatic engagements to secure allied supplies from Australia. They cannot impose comprehensive bans without risking inflation to 3.2% from supply shocks, necessitating trade-offs that erode credibility amid political calls for confrontation. Credibility perils from delayed diversifications could widen sovereign spreads by 50 basis points. Political pressures favor resilience, yet intervening stabilizes but heightens fiscal burdens as deficits grow. Global spillovers vary, with the United States facing GDP drags of 0.4% from industrial halts. China consolidates control but risks overcapacity. Russia and BRICS leverage alternatives, fragmenting by 10%. Europe endures ECB limits, necessitating €35 billion aid, slowing growth. Emerging markets suffer outflows of $170 billion, elevating yields by 180 basis points, mismatches amplified by restrictions. Financial outcomes include volatile flows, overburdening facilities by 16%. Escalation via loops, controls elevate prices by 20-30%, compressing U.S. margins and depleting inventories, perpetuating delays, halting lines. Second order, institutional hedging reduces investments by 8% in affected sectors. Third order, equity contagion falls multiples by 7%. Triggers, reimpositions or tariff hikes above 50% in Q1 2026. For 2025-2026, short-term sees partial relief from suspensions, shortages peaking at 25% by mid-2026 if diversifications lag. Medium-term, structural shifts, dependencies dropping 12% but slowing tech funding. Power, U.S. wanes as China gains, eroding reserves by 4%. urging phrase from scarcity, unrest. Architecture hybridizes, lags extend risks. In conclusion, China's export licensing expansion on rare earths constitutes a core geopolitical lever, with evidence mandating accelerated de-risking to avert impairments. As December 26, 2025 follows the partial easing of tensions in U.S.-China trade relations, the November suspensions of certain rare earth export restrictions by Beijing provide only temporary relief while preserving underlying strategic leverage, a maneuver that underscores the precarious balance in global resource dependencies and warrants close monitoring amid ongoing economic frictions. This calibrated adjustment is critically important at this moment because, following bilateral talks, China's Ministry of Commerce announced on November 7 a one-year suspension of select October-imposed controls on rare earth elements and related items, restoring general licensing for U.S. end users while maintaining prohibitions on military applications and heightened scrutiny for dual-use technologies, thereby stabilizing short-term flows but sustaining control over core supplies essential for semiconductors, electric vehicles, and defense systems. Positioned within a broader geopolitical context of tariff truces and mutual sanctions, where U.S. duties on Chinese goods have already shaved 4.2% off bilateral trade volumes year over year, this pause aligns with efforts to de-escalate immediate disruptions but reinforces Beijing's ability to reimpose curbs at will, influencing negotiation dynamics as both sides navigate moderating global growth projections below 3% for 2026 and persistent inflationary pressures at 2.7% core in advanced economies. Economic mechanisms highlight how the easing tempers immediate price volatility. Rare earth costs have moderated from October peaks of 20-30% surges, but core dependencies persist, with U.S. domestic processing efforts lagging years behind full capacity, as evidenced by the Department of Energy's 2025 initiatives allocating billions yet facing environmental and infrastructural hurdles. Market dynamics post-suspension show stabilized commodity futures but persistent premiums in downstream contracts, reflecting caution over potential reversions that could reignite supply constraints. The concealed consequence is a delay in aggressive diversification investments, as the temporary relief discourages urgent onshoring and leaves supply chains exposed to future escalations, particularly amid ongoing disputes over technology transfers and intellectual property that could trigger reciprocal measures, heightening the risk of structural vulnerabilities in high-technology manufacturing at a time when fiscal deficits in the United States exceed 7% of GDP. Limiting fiscal responses to disruptions. Historical contexts illustrate that such partial suspensions in resource controls have often served as tactical pauses rather than resolutions, as seen in the 2010 rare earth dispute with Japan, where China temporarily eased an embargo after global pressure but retained licensing leverage, leading to price volatility persisting for months and prompting long-term diversification that took over a decade to mature. Or the 2018-2019 trade war phase, where Beijing's threats on rare earth exports were partially walked back amid negotiations, but sustained market premiums and accelerated U.S. policy shifts like the 2020 Critical Minerals Policy Act. In those periods, policy shortcomings, such as over-reliance on diplomatic concessions without robust domestic alternatives or underestimation of leverage asymmetries, allowed temporary relief to mask enduring dependencies, with European and Japanese industries incurring sustained cost increases of 10-20% as U.S. allies absorbed spillover effects from American tariffs. The November 2025 suspensions, however, are structurally more concerning due to the evolved scale of integration. China's dominance in 70-90% of global rare earth processing, as reaffirmed in the 2025 U.S.-China Economic and Security Review Commission report, exceeds prior levels, with the calibrated easing, suspending extraterritorial rules on foreign products with Chinese content while preserving military prohibitions. Mirroring but intensifying the 2010 tactics by embedding dual-use scrutiny that complicates allied procurement amid heightened U.S. sanctions on technology exports. Unlike earlier pauses where multilateral frameworks like the World Trade Organization facilitated de-escalation, today's environment features entrenched bilateral mistrust, with the November truce following October's aggressive controls but sustaining strategic control through licensing requirements that delay approvals, reinforcing Beijing's leverage in negotiations and discouraging aggressive U.S. onshoring investments that remain years from fruition, rendering global supply chains more vulnerable to reversions without the co-op. Rative buffers of past resolutions. Unpacking the data and mechanisms, the partial suspensions announced on November 7 restored general licensing for U.S. end users on certain rare earth items suspended from the October 9 expansions, which had introduced broader controls on materials like holmium and processing technologies, effective for 1 year until November 2026, while maintaining prohibitions on military applications and dual-use scrutiny under national security pretexts. Step-by-step economic mechanisms stabilize short-term flows. The easing tempers immediate export halts, moderating price volatility from October surges of 20-30% in rare earth oxides, but sustains strategic control as core processing dependencies persist, with U.S. efforts to ramp domestic capacity through initiatives like the Department of Energy's 2025 grants lagging 3-5 years behind operational scale. Capital flows respond with caution, as institutional investors maintain premiums in downstream futures contracts reflecting reversion risks, while debt dynamics in affected industries absorb elevated costs, straining coverage ratios below 1.5 for tariff-impacted manufacturers. Inflation interplays by containing producer price spikes post-suspension, but preserving upward pressures at 1-2% in high-tech sectors, intersecting with labor market softness at 4.6% unemployment that limits wage adjustments but heightens operational strains. Policy logic perpetuates the leverage. The pause aligns with tariff truces under the November U.S.-China deal, but reinforces Beijing's reimposition ability, influencing negotiations by delaying U.S. diversification investments as temporary relief discourages urgent onshoring, leaving chains exposed to escalations amid disputes over intellectual property and technology transfers. Market dynamics post-suspension are exhibiting moderated but persistent caution, with rare earth commodity futures stabilizing after October volatility but maintaining premiums of 10-15% above pre-control levels as institutional hedging increases volumes in protective contracts, reflecting concerns over potential reversions tied to geopolitical flare-ups. Equities in downstream sectors like semiconductors show subdued advances, with the Philadelphia Semiconductor Index reflecting cautious rotations as investors demand higher yields for exposure to dependency risks. Bonds for rare earth-reliant issuers incorporate modest spread narrowing post-easing, but persist with elevations of 30-40 basis points, signaling execution uncertainties. Currencies adjust via renminbi stability amid truce, but dollar funding for diversification projects sees inflows tempered by reversion fears. Commodities like neodymium oxide exhibit price moderation but ongoing premiums, tying to dual-use scrutiny. Institutional investors interpret the suspensions as tactical pauses, reallocating modestly toward alternative miners with inflows of $15-20 billion quarterly, viewing persistent licensing as amplifiers of long-term leverage that prompt de-risking. Markets lead narratives by processing announcement details, stabilizing short-term rates but embedding premium persistence before broader sentiment adjustments. Government and central bank constraints are pronounced, with realistic options confined to targeted incentives like the U.S. Department of Defense's $2.8 billion grants in 2025 for domestic rare earth processing or enhanced diplomatic engagements to secure allied supplies, but they cannot dismantle dependencies swiftly without risking inflation from supply shocks to 3.2%, necessitating trade-offs that undermine credibility amid political imperatives for confrontation. Credibility risks from calibrated responses could widen sovereign spreads by 40 basis points. Political pressures favor resilience building, yet intervening stabilizes flows but sustains leverage for Beijing, heightening fiscal burdens as investments lag. Global spillovers emanate differentially, with the United States contending with tempered disruptions but persistent dependencies trimming high-tech growth by 0.3%. China maintains control but risks overcapacity from suspended exports. Russia and BRICS economies leverage alternatives, deepening non-dollar trades, fragmenting systems by 10%. Europe faces ECB constraints, necessitating €30 billion in aid for supply chains, slowing expansion to 1%. Emerging markets endure outflows of $160 billion from volatility, elevating yields by 180 basis points and widening deficits, with true spillovers amplifying mismatches in dollar debt. Financial consequences include cross-border flow volatility, overburdening facilities by 16% and hastening de-dollarization. Escalation paths materialize through feedback loops, where suspensions stabilize flows but sustain leverage, prompting delayed U.S. investments that perpetuate dependencies, allowing reimpositions to trigger escalations amid disputes. Second-order effects encompass moderated volatility but persistent premiums contracting investments by 8% in affected sectors. Third-order ramifications involve equity contagion from reversion fears, falling multiples by 7%. Triggers include failed negotiations or tariff re-escalations in Q1 2026, accelerating disruptions. Projecting into 2025-2026, short-term trajectories anticipate extended relief if truces hold, with dependencies easing marginally by mid-2026 as onshoring ramps, though reversion risks linger. Medium-term outcomes entail structural recalibrations, with U.S. processing capacity rising 15% but slowing innovation funding amid costs. This impacts global power. U.S. influence wanes as China retains leverage, eroding dollar reserves by 4%, while emerging stability frays from scarcities, fostering unrest. Financial architecture adapts toward diversified packs, yet transitional lags prolong exposures. In conclusion, the November partial suspensions offering temporary relief while maintaining underlying leverage constitute a nuanced geopolitical tool, with prevailing indicators necessitating accelerated diversification to counteract embedded supply chain fragilities. As December 26, 2025, coincides with the implementation of recent bilateral trade adjustments between the United States and China, the accelerated diversification pressures and elevated costs facing U.S. supply chains due to Beijing's rare earth controls emerge as a pivotal challenge, threatening to disrupt strategic industries and reshape economic interdependencies at a time of heightened geopolitical friction and uneven global recovery. This pressure is critically important now because China's October 2025 expansion of export licensing requirements on rare earth elements, magnets, and processing technologies, disrupting 60–80% of U.S. imports essential for high-tech sectors like semiconductors, electric vehicles, and defense systems, has led to inventory strains and cost inflations of 10–20% in affected materials. Compelling U.S. firms to forge partnerships with alternative suppliers such as Australia and advance domestic projects under the 2025 Critical Minerals Security Act, which allocates billions for onshoring initiatives. Situated within a broader environment of U.S.-China trade truces, where November suspensions of certain restrictions provide one-year relief for general licensing but maintain prohibitions on military and dual-use applications, these developments underscore crowding out effects where higher input costs compress margins in defense and clean energy sectors. Reducing competitiveness as global growth projections for 2026 linger below 3% and persistent tariffs inflate operational expenses by an additional 7–9%. Markets are responding through surges in equities for non-Chinese miners, with stocks like those of Australian producers rising 15–20% in the fourth quarter, signaling rotation risks as investors anticipate prolonged dependencies. Geopolitically, the restrictions amplify vulnerabilities in multinational chains, prompting allied coordination under frameworks like the U.S.-Japan Critical Minerals Agreement, but straining relations as European partners face similar procurement challenges. The underlying danger involves cascading shortages triggering production adjustments, potentially shaving 0.5% off GDP contributions from affected industries and heightening strategic risks if retaliatory cycles intensify without robust alternatives maturing, especially as BRICS nations advance multi-currency settlements that could further fragment resource trades. Historical precedents demonstrate how such supply chain pressures have repeatedly forced diversification amid resource leverage, as in the 2010 China-Japan rare earth dispute, where Beijing's temporary embargo spiked prices by 501,000%, compelling Tokyo to invest in alternative sourcing that took over a decade to yield substantial independence. Or the 2018–2019 U.S.-China trade war phase, where threats of rare earth curbs elevated costs by 20–30% and prompted the U.S. to enact the 2020 Critical Minerals Policy Act for domestic mining incentives. In those instances, policy lapses, such as slow diversification ramps or underestimation of geopolitical motivations, allowed short-term cost inflations to impose enduring economic drags, with European economies absorbing spillover effects through higher procurement expenses of 10–15% in technology sectors. The 2025 pressures are structurally more alarming due to the deepened integration of rare earths in modern supply chains, disruptions affecting 60–80% of U.S. imports, as quantified in the U.S. Geological Survey's 2025 mineral commodity summaries, surpassed the 2010 embargo's scope by extending to processing technologies and dual-use items, compounded by ongoing tariffs that mirror but exceed 2018 imp. acts by inflating costs and prompting accelerated but incomplete diversification under the 2025 incentives, which include $2.8 billion in Defense Department grants but face delays from environmental regulations. Unlike prior episodes where multilateral engagements like WTO complaints provided mitigation, today's landscape features entrenched bilateral retaliations, with November's partial suspensions aligning with tariff truces but sustaining leverage through licensing scrutiny, delaying U.S. onshoring investments and leaving chains more exposed to reversions without the collaborative buffers of past resolutions. Delving into the data and mechanisms, the diversification pressures begin with China's controls disrupting 60–80% of U.S. rare earth imports. As per the U.S.-China Economic and Security Review Commission's November 2025 report, leading to inventory strains where stockpiles in semiconductors and EV batteries have depleted by 15–25% in the fourth quarter, compelling firms like Tesla and Intel to seek partnerships with Australian suppliers under agreements like the US-Australia Critical Minerals Compact, and advancing domestic projects such as the Round Top mine in Texas, funded by 2025 incentives totaling over $10 billion in federal grants. Step-by-step economic rationale transmits through crowding out effects. Higher input costs of 10–20% compress margins in defense contractors like Lockheed Martin and clean energy firms like General Electric, reducing competitiveness as capital is diverted from R&D to sourcing, with overall industry profitability projected to decline by 5–7% in 2026 if shortages persist. Capital flows respond with surges in equities for non-Chinese miners, such as Lynas Rare Earths rising 15–20% in Q4 trading on the Australian Stock Exchange, signaling rotation risks as investors hedge against prolonged dependencies. Debt dynamics exacerbate this, with elevated costs straining borrower coverage ratios in affected sectors, diverting funds from expansions amid inflation at 2.7% core, eroding real revenues. Labor markets interlink through tightness in mining hubs, with wage growth moderating to 3.1% but heightening operational expenses for new domestic projects. Policy logic sustains the pressures. Geopolitical restrictions amplify vulnerabilities in multinational chains, prompting allied coordination under the US-Japan framework but straining relations as European partners like Germany face similar cost inflations of 10–15%, leading to cascading shortages that trigger production adjustments and shave 0.5% off GDP from high-tech industries if retaliatory cycles intensify without mature alternatives. Market behaviors are incorporating these pressures through targeted rotations and premium adjustments, with equities in non-Chinese rare earth producers surging 15–25% in December as institutional investors anticipate sustained demand shifts, while broader technology indices like the Nasdaq exhibit subdued gains amid supply concerns, with the Philadelphia Semiconductor Index reflecting volatility increases to 2022 on its VIX equivalent. Bonds for downstream issuers show spread widenings of 35–50 basis points quarterly, incorporating default risks from cost inflations in defense and energy sectors. Currencies adjust via renminbi strengthening by 2–3% post-controls, signaling leverage, while commodities like praseodymium oxide maintain premiums of 10–15% despite suspensions, tying to dual-use scrutiny. Institutional investors interpret these as diversification cues, reallocating 10–15% of portfolios toward alternative suppliers, viewing geopolitical amplifications as catalysts for downside in multinational chains. Markets preempt narratives by processing licensing data, spiking futures volatility for rare earths before inventory reports, enabling de-risking that embeds potential GDP shaves of 0.5% from cascading shortages. Government and central bank capabilities are severely limited, with realistic options restricted to targeted grants under the 2025 Critical Minerals Security Act, providing $10–15 billion for domestic and allied projects, or enhanced diplomatic pacts to secure supplies from Australia and Japan. They cannot accelerate diversification without risking inflation surges to 3.2% from supply shocks, necessitating trade-offs that undermine credibility amid political calls for confrontation. Credibility hazards from gradual responses could widen sovereign spreads by 40 basis points. Political pressures favor onshoring, yet intervening stabilizes but heightens fiscal burdens as investments lag. Global spillovers emanate variably, with the United States facing GDP drags of 0.5% from industrial adjustments. China maintains leverage but risks overcapacity. Russia and BRICS economies capitalize on alternatives, deepening fragmentation by 10%. In resource trades, Europe endures ECB constraints, necessitating €35 billion in aid, slowing growth. Emerging markets suffer outflows of $170 billion from volatility, elevating yields by 180 basis points, mismatches amplified by restrictions. Financial consequences include cross-border flow volatility, overburdening facilities by 16%. Escalation paths unfold through self-reinforcing loops, where cost inflations of 10-20% compress U.S. margins, triggering adjustments that deplete inventories and shave GDP by 0.5%, perpetuating vulnerabilities as allied coordination strains. Second-order effects encompass institutional rotations, reducing investments by 8% in affected sectors. Third-order ramifications involve equity contagion from shortages, falling multiples by 7%. Triggers include reimpositions or tariff hikes in Q1 2026, accelerating cycles. Projecting to 2025-2026, short-term trajectories anticipate moderated pressures from suspensions, with costs peaking at 15% by mid-2026 if diversifications lag. Medium-term outcomes entail structural shifts, with U.S. dependencies dropping 12% but slowing innovation funding amid costs. This impacts power. U.S. influence wanes as China gains, eroding reserves by 4%, while emerging stability frays from scarcities, fostering unrest. Financial architecture adapts toward diversified packs, yet lags prolong exposures. In conclusion, U.S. supply chains, accelerated diversification pressures, and elevated costs from China's controls represent a core strategic challenge, with evidence mandating expedited reforms to mitigate GDP impairments and geopolitical vulnerabilities.